Welcome to Finance Deep Dive. Today, we're going to talk about what might just be the single most important number in the entire world of monetary policy. Yep, that's the one. 2%. The Federal Reserve's inflation target. It's not 1%, it's not 3%, it's exactly 2. And believe me, this one little number, it guides trillions of dollars in economic decisions. Everything from the interest rate on your mortgage to the health of the entire job market. You'd probably assume it's the result of some super complex economic formula, right? Well, you'd be wrong. Its origin story is way more surprising and, honestly, kind of accidental. Okay, so let's get into it. The whole idea of a 2% target wasn't even born at the Fed, or anywhere in the United States for that matter. Nope. It started halfway around the world as this pretty radical experiment. Picture this. It's the late 80s, and New Zealand is getting absolutely crushed by crippling double-digit inflation. So what do? In this incredibly bold move, its central bank pioneered the world's very first explicit numerical inflation target. It was a brand new way to prove to the public they were dead serious about getting prices back under control. And you know what? The idea caught on. It spread. By 1996, policymakers over at the US Fed had their own little secret agreement, 2%. That was their number. But here's the crazy part. They didn't tell the public for another 16 years. It was an implicit target that markets could sort of guess, but it definitely wasn't an official promise. For years, the Fed chair at the time, Alan Greenspan, operated with what people called purposeful ambiguity. He really believed that picking a specific number would just tie the Fed's hands. For him, price stability was more of a vibe, a state where regular people just don't even have to think about inflation in their daily lives. But his successor, Ben Bernanke, came in with a totally different take. He basically said, look, the magic isn't in the number itself, but in being transparent about it. He argued that announcing a clear public target helps anchor everyone's expectations, which makes the Fed's job a whole lot easier because you have everyone working with the same goal in mind.
Okay, so this brings up a huge question, right? Why not just target zero inflation? Wouldn't that be perfect price stability? Well, the answer is this really big constraint in economics called the zero lower bound. The short version is you can't really cut interest rates below zero. I mean, if you did, people would just pull their cash out of the bank and stick it under the mattress.
And that's where the 2% target comes in. It acts like a buffer, a cushion. It keeps interest rates a little bit away from zero when times are good. That gives the Fed some precious room to cut rates and stimulate the economy during a recession. That 2% cushion is the main theoretical justification for aiming for a little bit of inflation rather than none at all. But that very same cushion, well, it's now at the heart of this huge, fierce debate. In today's world, is 2% still the right number? Or is it actually dangerously low? And this whole debate really comes down to a core trade-off. On one side, you have the defenders of the 2% target. They say, hey, this is the bedrock of our credibility. We can't change it now. They're worried it would unanchor expectations and start a slippery slope. But on the other side, you've got critics arguing for a 4% target, saying it would create a much bigger buffer to fight recessions and reduce the risk of hitting that zero lower bound. And proponents of a higher target, like economist Lawrence Ball, argue the benefits are clear. A 4% target would mean more room to cut rates, leading to less severe recessions and faster recoveries, with minimal costs, because, in his words, the economy can live comfortably with that level of inflation. But man, central bankers, they almost universally reject this idea. Bernanke is adamant about it. They fear that changing the goalposts now would just destroy decades of hard-won credibility. I mean, think about it. If they move it to 4%, what's to stop them from moving it to 6% in the next crisis? It could unmoor public trust, making inflation way harder to control. Okay, so if you're gonna stick to a target, you have to be able to measure it first, right? And as it turns out, not all inflation measures are created equal. The Fed has a very specific preference. So whenever you hear about inflation on the news, they're almost always talking about the Consumer Price Index, or CPI. But here's the thing, that's not what the Fed targets. They have a different, preferred index. The Fed prefers the Personal Consumption Expenditures, or PCE, price index, and there are some really key reasons for this. First, the PCE is broader, covering spending by all households, not just urban ones. More importantly, its formula is chain-weighted and updated monthly, which means it better captures when people substitute away from expensive items, like choosing chicken when beef prices soar. This makes it a more dynamic measure of inflation. And this is exactly why the choice of index matters so much. Because of those differences, CPI inflation has historically run about zero point 0.4 percentage points higher than PC inflation. So when the Fed says its target is 2%, they mean 2% PCE, which translates to roughly 2.4% for the CPI that you more often hear about. So after decades of low inflation, the post-pandemic world put the Fed's entire 2% framework to its biggest test in a generation. I mean, with inflation soaring to levels we hadn't seen in 40 years, many questioned if the 2% target was still relevant, or if the Fed would be forced to just abandon it. So, in 2025, the Fed conducted a major review of its entire strategy. It was a moment of truth. Would they stick with 2%, raise the target, or change the framework entirely? The verdict was clear. 2% is here to stay. The Fed forcefully reaffirmed the target, signaling that it remains the non-negotiable anchor of its policy. But, and this is a big but, while the number stayed the same, the strategy for how to achieve it changed significantly. They officially dropped their 2020 strategy known as Flexible Average Inflation Targeting, or FAIT. This was an approach where they aimed to let inflation run hot to make up for past periods when it was too low. The new framework is a more flexible and balanced approach. It signals they won't be bound by a rigid formula, but will act forcefully to keep long-term inflation expectations locked at 2%. And that leaves us with the critical question for the future. The 2% target is not a scientific law. It's a hard-won, pragmatic policy choice that has now survived its greatest test. But as our economy continues to evolve, will it remain a vital anchor providing stability, or will it become a dangerous constraint in the next crisis? I guess only time will tell. That's all for this video. If you like the content, don't forget to subscribe to Finance Deep Dive. It motivates us to keep posting.